Berkshire Hathaway is worth over $900 billion. Warren Buffett is worth over $100 billion. He could borrow money at interest rates lower than almost any individual or institution on earth. Banks would line up to lend to him at whatever terms he wanted. He almost never does it. Not because he cannot afford the interest. Not because he lacks discipline. Not because the leverage would not mathematically amplify his returns in many scenarios. Because he has a specific, deeply considered view about what debt does to your ability to think clearly, act rationally, and survive the periods of market volatility that will, with absolute certainty, occur during any investment lifetime. And that view has implications for ordinary investors that go far beyond the question of whether to use a credit card. In this video, I am going to walk you through the 5 reasons Buffett almost never borrows, the specific, concrete arguments he has made across 6 decades of shareholder letters, annual meetings, and public interviews. Reason 3 is the one that most financial advisors never tell you about. It is the psychological cost of debt that no interest rate calculation captures. And it may be the most important reason of all 5. Stay with me. Let me be precise about what Buffett's position on debt actually is, because it is more nuanced than never borrow money. Berkshire Hathaway uses debt at the corporate level in specific and carefully controlled ways. Its insurance subsidiaries carry debt. Its utility businesses carry debt appropriate to regulated, stable cash flow businesses. Its railroad BNSF carries modest debt. What Buffett almost never uses is financial leverage for investment purposes, borrowing money to amplify the returns on investment positions. And personally, he has never used leverage. He built a $100 billion fortune entirely from investing his own capital and the capital of his partners, never borrowing to magnify returns, even when the mathematics of a specific situation might have suggested it would be profitable. His reasoning has been stated consistently across decades. Leverage, in his view, is not a tool that improves the best-case outcome by enough to justify what it does to the worst-case outcome. It converts situations that would be temporarily painful into situations that can be permanently devastating. And in investing, the difference between temporary pain and permanent loss is the entire game. He has watched more investment careers end, not from bad analysis but from good analysis combined with leverage, than from almost any other single cause. Here are the 5 reasons he has articulated for why he almost never borrows. Debt converts temporary loss into permanent ruin. The fundamental argument. Buffett's first and most important argument against investment leverage is mathematical and absolute. Without debt, a bad investment produces a loss. A temporary loss, in most cases, the business may recover, the market may re-rate the position upward, the thesis may eventually prove correct. The investor who made a mistake can hold, reassess, and either wait for recovery or exit at a manageable loss. With debt, a bad investment can produce a total loss, not just of the investment but of the collateral used to secure the loan, and potentially of assets entirely unrelated to the original investment. When a leveraged position falls in value, lenders issue margin calls, demands for additional collateral or immediate repayment. These calls arrive at the worst possible moment, during market declines, when all assets are falling simultaneously and cash is most difficult to raise. The leveraged investor is forced to sell at the bottom, converting a temporary paper loss into a permanent, crystallized one. The historical evidence. Buffett has studied virtually every major financial crisis in history. His consistent observation, in every case, the investors who were wiped out, not merely damaged but completely destroyed, were almost exclusively leveraged investors. In 1929, most investors who lost everything were not unsophisticated speculators. Many were highly intelligent, analytically capable people who had used margin debt to amplify positions in genuinely good businesses. The businesses eventually recovered. The investors never did, because the margin calls in 1930 and 1931 forced them to sell their holdings at distressed prices before the recovery arrived. In 2008, the same pattern. Hedge funds and individual investors with leveraged positions in mortgage-backed securities were destroyed not because their long-term analysis was wrong. Many of those securities eventually recovered significant value, but because they could not survive the short-term margin calls. The businesses were fine. The leverage was the killer. What you do. If you are currently using margin debt or any form of investment leverage, Calculate your position under a scenario where your portfolio falls 40%, approximately the decline experienced in both 2000 and 2008. Would margin calls force you to sell at that level? If yes, you are carrying a risk that can convert temporary paper losses into permanent capital destruction. The question is not whether you can afford the interest, it is whether you can survive the margin call. Reason 2 is about timing, specifically why debt removes the single most important advantage an investor has: the ability to choose when to act. Debt removes your most valuable asset, time and optionality. The optionality argument. Buffett considers optionality, the ability to act when you choose rather than when you are forced, one of the most valuable things an investor can possess. A debt-free investor facing a market decline has complete optionality. They can hold their existing positions. They can buy more at lower prices. They can do nothing. They can wait indefinitely for conditions that favor action. A leveraged investor facing the same decline has no optionality. The lender determines the timeline. Margin calls arrive on the lender's schedule, not the investor's. The decision to sell is made not by the investor's analysis, but by the lender's risk management policy. This asymmetry between the freedom of the debt-free investor and the coercion of the leveraged one is, in Buffett's view, the single most important practical difference between the two situations. Berkshire's optionality as competitive advantage. Berkshire's famous cash position, currently over $330 billion, is not simply idle money waiting to be deployed. It is a reservoir of optionality. When major financial crises occur, Berkshire can act immediately, decisively, and at terms of its choosing, because it has no debt obligations constraining its actions and unlimited capital available for deployment. In September 2008, at the peak of the financial crisis, Goldman Sachs needed capital urgently. Buffett provided $5 billion within 24 hours, at 10% interest plus warrants, because Berkshire had the cash and the absence of competing debt obligations. Goldman had no leverage in the negotiation. Buffett had complete leverage because he was the only source of capital available at that moment. That negotiating position, achieved entirely through decades of avoiding debt, was worth billions of dollars in a single transaction. What you do: maintain a cash position that gives you genuine optionality during market dislocations. Not a trivial amount, a meaningful reserve that would allow you to deploy capital opportunistically if markets fell 30 to 40%. The return on this cash in normal periods is lower than fully invested alternatives. The return during market crises, when you can buy at distressed prices while others are forced sellers, more than compensates over full market cycles. Reason 3: the psychological cost. The one most financial advisors never discuss. And the one Buffett has said matters more than all the interest rate calculations combined. Debt corrupts your thinking, the hidden psychological cost. The peak reason, what most people never consider. The most important reason Buffett avoids debt is not financial. It is psychological. Debt changes how you think. Specifically, it introduces a permanent background anxiety about whether your investments will perform well enough to cover your obligations, and that anxiety corrupts the quality of your investment decisions in ways that are subtle, pervasive, and almost impossible to eliminate through sheer willpower. An investor without debt can evaluate any investment situation calmly, on its merits, with a genuinely long time horizon. They can hold a position through a 30% decline because they have no obligations that require the position to recover on any particular timeline. An investor with debt, even debt that appears entirely manageable, carries a constant background awareness that the positions need to work. This awareness does not always manifest as conscious anxiety. More often it manifests as a systematic bias in decision-making, a tendency to take profits too early because the gain feels safe, and to hold losses too long because realizing them would be an admission that the leveraged position was a mistake. Buffett's specific observation. Buffett has described watching brilliant investors make decisions under the psychological pressure of debt that they would never have made in a debt-free position. Not because they forgot their analytical frameworks, but because the framework itself was being applied from a position of implicit constraint. When you need the investment to work, when your personal financial security depends on a specific outcome, you stop evaluating the investment and start defending it. You look for evidence that confirms your thesis. You discount evidence that contradicts it. You hold on past the point where the analysis would have told a debt-free investor to exit. He has said that the inability to think clearly about an investment when you are financially exposed to its outcome is the most underappreciated risk in all of leveraged investing. It is not on any balance sheet. It has no interest rate, but it costs more in aggregate than the explicit financial costs of debt. What you do: evaluate your current investment positions under a mental exercise. Imagine you have no debt and no financial obligations. From that position of complete freedom, would you make the same investment decisions you are currently making? If any position looks different from a debt-free perspective, if you would hold less or exit something or never have entered at all, that is the psychological cost of debt manifesting in your decision-making. It is telling you something important about whether your current positions are genuinely chosen or implicitly constrained. Reason 4 is about smart people specifically, why leverage has destroyed more brilliant investors than any other single factor in financial history. Smart people use leverage, and that is exactly the problem. The counterintuitive observation. Buffett has made an observation about leverage that sounds counterintuitive the first time you hear it. The most dangerous users of leverage are not unsophisticated people who do not understand the risks. They are sophisticated, highly intelligent people who understand the risks very well, and whose intelligence causes them to underestimate those risks in precisely the situations where they are highest. The reasoning. Intelligent investors who use leverage do so because they have analyzed a specific situation and concluded that the expected return from leveraged ownership exceeds the expected cost of the debt. And they are usually right. In most scenarios, their analysis is correct. The problem is the tail risk. In most environments, leverage works exactly as the intelligent analysis predicted. In rare, extreme environments, the 1929 crash, the 2008 crisis, the 1998 LTCM collapse, leverage interacts with market dislocations in ways that even sophisticated models do not capture. And in those moments, the intelligence that made leverage seem manageable is precisely the quality that made the investor willing to take a risk that turned out to be fatal. Long-term capital management, the clearest example. Buffett has cited long-term capital management repeatedly as the definitive illustration of this principle. LTCM was run by 2 Nobel Prize-winning economists and some of the most sophisticated quantitative analysts in the world. Their models were extraordinarily rigorous. Their risk management was considered state-of-the-art. They were, by any measure, among the most intelligent investors who had ever operated in financial markets. They also used leverage of approximately 25-to-1 at their peak, borrowing $25 for every $1 of their own capital. In 1998, a series of market dislocations, the Russian debt default, the unwinding of other leveraged positions, caused correlations to move in ways their models had assigned near-zero probability. Their positions moved against them simultaneously. The leverage magnified the losses. Within weeks, a fund that had generated extraordinary returns for years was insolvent, requiring a Federal Reserve-orchestrated bailout to prevent wider market contagion. The intelligence was not the problem. The leverage was the problem. And the intelligence, by providing confidence in the models, made the leverage feel safer than it was. What you do. When you find yourself constructing an argument for why a specific use of leverage is safe, why this situation is different, why the downside is limited, why the probability of the worst case is negligible, treat that argument as a warning signal rather than reassurance. The most dangerous leveraged positions in history have almost always been accompanied by sophisticated arguments for why the leverage was manageable. The sophistication of the argument is not evidence of safety. In some cases, it is evidence of the exact overconfidence that makes leverage catastrophic. Reason 5 is Buffett's most personal, the specific standard he applies to his own finances that has nothing to do with optimizing returns. Sleep well, the life standard that overrides the financial one. Buffett's personal standard. Beyond the financial and psychological arguments against debt, Buffett has articulated a personal standard that overrides all of them. A standard that is not about maximizing returns, but about living a specific kind of life. He has said, in various forms across many years, that his goal is to be able to sleep well at night. Not to maximize every last basis point of return. Not to fully utilize every opportunity that leverage could have amplified. But to go to bed each night without anxiety about whether his financial position is secure. He has described this as a non-negotiable personal requirement, not a financial preference, but a life standard that his investment approach is specifically designed to support. What this reveals about his priorities. The Sleep Well standard reveals something important about how Buffett thinks about the relationship between money and well-being, something that most financial optimization frameworks completely ignore. Leverage, in many situations, would have produced higher financial returns for Buffett. He knows this, but it would have introduced an obligation to lenders, to margin requirements, to the performance of specific positions that would have required a quality of vigilance incompatible with the deep, unhurried thinking that his investment approach depends on. Debt-free investing is, in his framework, not a conservative choice. It is the choice that maximizes the quality of his thinking, and thinking quality, compounded over 60 years, is worth more than the additional returns leverage might have produced in any given period. He has also noted that above a certain level of wealth, one that provides genuine security and comfort for your family and yourself, additional wealth adds almost nothing to life quality. What adds to life quality is freedom. Freedom from obligation, from anxiety, from the need to perform for creditors. Debt, by creating obligation and anxiety, reduces freedom, and therefore reduces life quality, even as it increases the potential for higher financial returns. The deeper question. Buffett's Sleep Well standard invites a question that most financial planning conversations never ask. What is the money for? If the answer is security, the ability to live comfortably without financial anxiety, then the optimal strategy is one that prioritizes resilience over return. Debt reduces resilience. A debt-free portfolio with somewhat lower expected returns provides more genuine security than a leveraged portfolio with higher expected returns, because in the scenarios where you most need the security, the leveraged portfolio is exactly where you want to be least exposed. If the answer is maximum wealth accumulation, leaving the largest possible estate, then leverage may be justifiable, accepted with full understanding of the tail risks. Most people, when they reflect honestly, want security more than they want maximum accumulation. But the financial industry, which profits from activity and complexity, rarely helps them make that distinction explicitly. 5 reasons. 1 principle. From the man who could borrow more cheaply than almost anyone alive, and almost never does. Let's bring it together. Reason 1. Debt converts temporary loss into permanent ruin. Without leverage, a bad investment produces a manageable loss. With leverage, a margin call during a market decline can convert a temporary paper loss into permanent capital destruction, forcing you to sell at the exact moment you should be holding or buying. Reason 2. Debt removes your most valuable asset, time and optionality. The debt-free investor can hold indefinitely, act when conditions favor it, and deploy capital at crisis prices. The leveraged investor acts on the lender's timeline, not their own. Reason 3. Debt corrupts your thinking. The psychological cost of financial obligation, the background anxiety about whether positions will work, introduces systematic biases in decision-making that no analytical discipline can fully eliminate. You stop evaluating the investment and start defending it. Reason 4. Smart people use leverage, and that is exactly the problem. The sophistication that makes leverage feel manageable is the same quality that produces overconfidence in models that fail in tail risk scenarios. LTCM is the clearest example. It will not be the last. Reason 5. Sleep well. Above a certain level of security, additional wealth adds almost nothing to life quality. What adds to life quality is freedom from obligation and anxiety. Debt reduces that freedom, even when the financial mathematics appear to justify it. Here is the honest bottom line. Buffett is not telling you that debt is always wrong. Mortgages on sensibly priced homes, student loans for genuinely valuable education, business loans with cash flows that comfortably service the debt, these are legitimate, often sensible uses of borrowing. What he is telling you is that using debt to amplify investment returns is a specific and systematically underappreciated risk, one that has ended more investment careers and damaged more personal financial situations than almost any other single factor. His alternative is straightforward. Build your investment portfolio on capital you own, free and clear. Grow it through compounding rather than leverage. Maintain optionality so that market dislocations are opportunities rather than threats. And structure your financial life so that you can sleep through any market environment without anxiety. That standard, sleeping well, sounds modest. Over 60 years, it has produced $100 billion. This closes week 8. Week 9 continues next week with more from the series. The next video is right here.